All right. Hey, welcome. Today is December 4th, Tuesday, and I wanted to bring you a quick update on the stock market and what's going on with it because as you see here, the market was down across the board. We had the Dow down 3.1%, almost 800 points, NASDAQ down about 3.8%, and the S&P 500 down 3.24%, thanks to our good friends at FinViz for providing these charts. So, how are you doing? My name is Nathan Garcia. I am a certified financial planner and retirement planning specialist, and I want to do this video for you to help you understand what's going on and give you a resource in the event that you have some questions that you'd like answered and you don't have a direct line to Bloomberg or CNBC. So what we'll do here is just walk through some of the highlights of the market performance today. I'll give you some insights from me and my take, and then we'll dive into some of the specifics here. So with that being said, we're looking at the market here. You see that you have red across the board. If you notice this heat map over here, you'll notice that a lot of the big name companies were down significantly. And you might be asking yourself, why would this be the case given that we had positive news from Jerome Powell last week saying that the Federal Reserve is probably closer to stopping raising interest rates than further away, meaning that it doesn't look like interest rates are going to move up too much further. And then in Argentina, you had President Trump and China's President Xi, who met to discuss the trade war, and they mentioned that they were going to be able to come to an agreement there. So, why would the market start to react poorly today? Well, the answer is probably going to surprise you, but we'll get into that here in just a minute. So let's take a look here at some of the performance in the market itself. These charts come from Zero Hedge, zerohedge.com, and here you have a look at the overnight activity. You notice that this actually goes back, I think, about a month, but you'll notice that you had Fed President Jerome Powell come out and say that they don't think that they're going to raise interest rates too much further, and so the market got a big jump off that. And then you had the trade truce over the weekend, and you saw a big jump on that on Monday. And so overnight, what was interesting is that you had China and Europe who both came out, and the markets looked pretty good on their end. So it wasn't anything that globally that we saw that kind of ruffled the feathers. Instead, what occurred was that you saw a pretty significant sell-off early on. And the reason being is that there's speculation that this was a result of CTAs, basically the hedge funds. Essentially, it looks like some of these hedge funds are readjusting their risk, and as a result of that, they are getting rid of their equities, their stocks, and they are preferring to move that money into bonds. And this is really significant because last month, during the sell-off we saw last month, we saw that bonds and stocks sold off at the same time. And I'm going to show you how that wasn't the same situation here today in just a minute. So here we have a look at the E-mini futures, and then you see across the board the markets were down on all technical levels. Okay, so we look at this as 200-day, 100-day, and 50-day moving averages. This is just a technical reading of the market to determine the trends on a longer-term basis. And what was interesting about that was that the markets broke these key technical levels. The NASDAQ, the S&P 500, the Dow Jones, and the Russell 2000 all broke key technical levels. And as a result of that, you saw some of these trading algorithms readjust their risk and move out of bonds and out of stocks and into bonds. We also saw here that you're looking at the financials themselves. The financial companies globally, systemically important banks are down about 30% off of their 52-week highs. You've got U.S. financials that are down about 14.5% off their 52-week highs. You've got Goldman Sachs down about 33% off the 52-week highs. This is pretty significant when you think about it, because it's telling you that investors are not comfortable with holding bank stocks, and that could be for a number of reasons. Maybe it's because of the interest rate market. Maybe it's because of the amount of debt that's out there in the corporate world. There are a lot of different reasons that this could be the case, but regardless of it, it's not been positive to hold financials for the past year or so. So going back here, you see that financials weren't the only ones hit. In fact, FANG stocks, which have been a huge momentum play for the market this year, those are down pretty significantly as well. All across the board, you had the FANG ETFs themselves, or sorry, FANG stocks as a whole were down 22% off their 52-week high. And when you look at the individual names, you've got Facebook, Amazon, Netflix, Google, Apple. Facebook's down 36% off the 52-week high. Amazon down 17% off the 52-week high. Netflix down 34% off the 52-week high. Google down 17%, and Apple down 24%. So a lot of investors have moved into these stocks because they preferred the returns. Frankly, that's where the returns have been up until about October of this year. And now we're seeing a huge adjustment from money moving out of those tech stocks and into other places. So it's telling you that the market itself is starting to readjust, and that can be pretty significant because a lot of people were chasing the momentum trade with those FANG stocks, and if they haven't rotated into a different asset class, then they are feeling the pain right now. So here is a look at the S&P 500 compared to the 10-year yield. You notice that the 10-year yield is fallen, and the S&P 500 has fallen aligned with that. And so that's pretty significant. Basically, it could signal that investors prefer bonds again as a diversification hedge. You notice here that it wasn't just 10-year bonds. You also had the 30 years that picked up the most, that had the most appreciation here. And the 30 years actually fell about 13 basis points, so they had the biggest move of the day, whereas your 2 years actually lost money. So pretty significant, because it looks like investors are moving into these bonds, and that could be a pretty significant change for the time being. You also notice that the 10-year yield is coming back down, and then here you're looking at the 30-year bond yield, which broke the 200-day moving average. So again, from a technical standpoint, it looks like this is positive for 30-year bonds. So pretty interesting move there, something that you want to keep an eye on. A lot of people will move into commodities at a time where the stocks or bonds start to sell off. What's interesting is that you had oil and copper both sold off, whereas silver and gold really remained flat. So just a note there that investors don't think that you should just buy any commodities. They're preferring to buy, silver and gold. If you look at oil and copper, those are commodities that are used in a global expansion for building, for transporting goods, and the fact that those prices are falling down signals that investors don't believe that there's a lot of growth, or that there will be a lot of growth in the near future. So something that you want to keep an eye on. So I hope that you found this video helpful. If you did, make sure that you like it and leave me any comments below. I'm always interested in improving, and I'd be happy to get your input on doing so. If you have any questions about your situation, or you just like a second opinion on your investment portfolio and your risk in your portfolio, feel free to reach out to me, and I'd be happy to help you out. Thanks a lot, and look forward to seeing you in the next video.